Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny, and today we're going to talk about Dr. Michael J. Burry. Is he just another doomsayer of the stock market? Or as we hit all-time high here, are we ready to break out into new territory? We would love to hear your thoughts about that in the comments down below, but we're going to get to a bunch of data points about the economy and the stock market overall in this video.
Beautiful. Two Super Guys Trade Stocks.
All right. This is going to be a lot of slides, a lot of different like charts and stuff. But you remember when he was on Twitter, he was very vocal about saying like, greatest bubble of all time by 2 orders of magnitude. Sell, and then I was wrong to sell. And like I really respect him as an individual, but as time has evolved and my time in the market has evolved, and you hear these constant like opposing viewpoints, it's hard to filter out the noise and try to figure out what actually matters. Okay, and figure out how I should be best investing my money. All right, that's really what my goal is with this whole channel. Um, you're looking at SPY up here, barely with off all-time highs. Same thing goes for triple Qs, right? So we're sitting at like a potential area where we could break out into new territory versus, hit this level of resistance and sell back off. I don't know if you want to
Yeah.
talk about the individual charts a little bit more, Dylan.
Yeah, so basically, our goal with this video, Vinny is going to show a bunch of economic indicators that are either for or against, meaning this could be a bear thing, this could be a bull thing. We want to know what everyone thinks. If we think, hey, we're going to hit highs, and then a lot of times when you hit highs, highs cause higher highs. More people are very like, oh my gosh, we're going crazy. But it can also cause a reversal. So
Mm-hmm.
here's the cues. I focus on the cues specifically, but the SPY is very, very, very close. It is right there. We're like two away. It's like 0.2%.
Yeah.
Now the interesting thing, this is the Q and the SPY with the percentage weight. Now remember,
Mm-hmm.
these charts are more focused on Qs, but you can see that the majority of these companies, like 40%, is like 8 companies for the Qs.
Yeah.
It's a little bit less so in the SPY. So that kind of changes it.
Yeah,
Do
exactly.
we?
Both a lot of companies are enlisted in both, and the weighting is a little bit more aggressive in the triple Qs
Mhm.
towards the larger companies than it is in the SPY. But they're very highly correlated.
Right. Go to the next slide. Now, the problem is we could think that there's a bunch of recession economic indicators or a bunch of problems, but in reality, if like 8 companies are doing well, it's almost half the Qs. So it's not so much as a whole market going to do well, but are these 8 companies going to do well?
Mm,
So here is Apple, Microsoft, Nvidia, and Meta. Now, Apple, Nvidia, and Microsoft are Apple surpassed highs as of Friday. Nvidia and Microsoft are right there. They're super close. Okay. So right there, 25% of your entire Qs.
that's crazy.
3 companies,
It's only a little bit scary.
25%. Right?
Yeah.
Now, Amazon, Tesla, and Google, oh, there's a slash on Google. It's 5.5. Two stupid guys. That's what we do. Um, it's it's the greatest cop out ever. um, uh, Tesla, not so much. They're all healthy. They're all above the 200 moving average. But Tesla, Amazon, Google's a little bit closer. But you have another, what is that, 13, 14% that are close-ish to highs, but still have about 10% to go. All total, that's 43% of the Qs.
Yeah.
25% at highs now or very close to it, and then 43% close to it. Gross.
Yeah, I mean it's pretty crazy, and like what's driving a lot of this, right? This is kind of like the inverse of Dylan's TLT trade. We'll do a separate video on that, but this is the 10-year Treasury rates, and look at this just sell off here from 5%, right that back down to 4%. This is a really big time scale, right? I zoomed out to max here, so this is going well
Yeah,
back
you're
to the
like
early 90s.
1996.
But that's a pretty dramatic move. Okay, I mean, yeah, you see moves similar to that over throughout the course of the history. It's not exactly unprecedented in its pace, but it is very fast pace of movement there amongst the 10-year Treasury rates. the optimism behind the Fed has really been driving that, right? We're now looking at expecting multiple rate cuts next year based upon the CBOE expectations, or options pricing in. In the same token, we have the U.S. dollar has kind of come off from its highs here a little bit too. This is way back when, early 2000s. But you remember when the U.S. dollar was viewed as a sanctuary throughout the entire pandemic, and now we're kind of coming back down to more, I guess, realistic levels. So the same thing happens as the dollar decreases in value. You see assets expand in price. So that's why helping elevate the stock market there. And then another kind of data point worth tracking here, right? This is kind of get beat to death, but roughly 70% of the U.S. economy is consumer spending, right? And this is the Michigan Consumer Sentiment Index. You remember we set an all-time low, back here, like late 2022. We've rebounded from that level pretty significantly here without actually triggering a recession. If you look at these gray shaded sections in the past, when you saw a precipitous drop in Michigan consumer sentiment, you saw a recession be triggered there. No such event has occurred yet during this time period, which is pretty wild.
So that does almost kind of correlate. So our recent low with the Qs was October 2022. That's like the low of this. That's pretty close to where that was.
Yeah, but we didn't get that recession following that, which we've seen before. Now, in terms of employment, this is another kind of data point that's worth tracking. When you're looking at it was a seasonally adjusted unemployment rate down to 3.7%. We have seen the number of jobs created each month start to trend down over the last few months as the Federal Reserve has continued their tightening cycle. However, we're still creating net positive jobs on like a monthly basis here, and you still have the actual unemployment rate here tracking pretty consistently with one of the lowest levels seen in quite a long time. All right. This is labor force participation rate. So remember we did done the videos, we've mentioned this in the past. This is the portion of the population. I forget what age range it is, but the working age that are actually out there and employed.
18 to 60.
44 or something. I can't
40,
remember the upper limit. But it's been trending up throughout this entire time period too. We're almost back to pre-pandemic levels of labor force participation, which is awesome. So that's another positive you could argue for the economy.
15 to 64.
15 to 64. Okay, I was saying that's a pretty interesting set of numbers there. And don't forget, when you're looking at the economy overall, GDP, right? So the most recent GDP revision came out 5.2%. Just like absolute bananas numbers. Anticipate an economy as large as the U.S. government, U.S. economy, growing at 5% plus a year.
That was not sustainable at all.
No,
also,
definitely not.
I gotta correct myself. It's completely dependent on the graph. I tried to do this on the fly. There's some that are 25 to 50, so just forget what I said. But yeah.
No, I think 1564 sounds like the one that the Federal Reserve uses, because that was a Federal Reserve chart, the one I just showed you.
Yeah, I was trying to do that off the fly.
I believe that's correct. But the U.S. economy has still been growing despite all these challenges. We have a little bit of positivity here. This is the 30-year mortgage rate. So you've actually seen it decrease from 8% down to 7%. I saw a separate video recently talking about the spread between the 10-year Treasury yield and the 30-year mortgage. Typically, I want to say it was around 1.5%. If you remember, we just looked at the Treasury yield, the 10-year, and that was under 4%. So that meaning if that typical spread was there, it'd be a 5.5% mortgage rate right now. And it's 7 still after this movement. It was one of the widest spreads between the 10-year yield and 30-year mortgage we've seen in history, apparently, according to this other source.
That's just so depressing. And 7.5% mortgage on housing prices today are so gross.
Yes. The number of people that actually have a mortgage, I think over 7% is less than 1 or 2% in the U.S. It's very, very low. We're actually at a point right now where I want to say the number of homes wholly owned is 40% approximately, like no debt on the home at all. So we're actually one of the highest rates of no debt home ownership that we've seen in a long time.
I didn't know that.
Yeah, I thought it was an interesting point. Baby boomers, right? They're still aging in place. That's part of the trend. So, of course, with elevated home prices and high interest rates, this is a chart of U.S. home affordability. All right, as the chart goes up here, homes become more affordable. And look at the level we're at now. We've rebounded slightly over the last few months, but we're still at one of the lowest levels of home affordability since this index was created in 1996.
Yeah, I bought my first house in end of 2011, so it's very lucky for me.
Yeah,
It's very affordable.
that's a pretty good time on this chart right here. um, Now, this is another one that this kind of correlates with one of the final charts I'm going to show you that scares the living crap out of me. All right, this is the S&P
Hmm.
500 PE ratio. Okay,
Okay.
we've talked about this in the past. Historically, the PE ratio used to be around 15. That's
Hmm.
no longer really the baseline. I mean, just rough eyeball estimate here. For a long, long time, 15 seems to be around where it was kind of hovering, and then we've kind of reset since then. And ideally, a 20 is probably more representation or more representative of what we see now. But we're still at 26, so even decently above that.
Okay.
All right.
All right.
So this is looking at hourly wages, which is another kind of thing to think about. How healthy is the average worker? And during the pandemic, we saw a significant kind of pop up here as far as the rate increases in hourly earnings. That has trended down, which is good. You're trying to avoid like the wage price spiral, as Jerome Powell has talked about. So wage growth, you want to see some, but you don't want to see such an increased level that it's going to be driving inflation. But this is always good to know because you're looking at least a 4% raise, ideally from your employer this year, so you can track along with this.
Can you do me a favor? Go to the previous slide.
Yeah.
Um, so th- this is one of those things again where it's weird because when you look at previous data points, the entire index was not around 8 companies or 9 companies, right? So if you
Concentration.
take
Yeah.
Apple, let's just say they're 200 to make the math easy, 26, and let's say the average is 20. So you're looking for a 30% ish decrease in stock price. I just don't, now if you give me Nvidia, fair,
Okay.
100%,
Yeah.
maybe more than that,
Yeah.
right? But you give me Google, Meta, Microsoft. I mean, the numbers they're putting up, I just 30% lower just seems that would be a steal. I hope it happens.
Well, steel is a relative thing, right? Like we're gonna actually, I want to go back to this other chart that I was about to talk about, the Buffett indicator. So this is looking at a ratio between the stock market total market capitalization and GDP, meaning that ideally they should track each other, right? The stock market valuation should roughly represent or have a good relationship with the U.S. economy overall. All right. So the center line here is the historic trend line of these two things. Right? And as we become further away from it, we're getting a little bit further out in the statistical distribution. If you imagine like a bell-shaped curve around what like the fair value should be and how kind of extended we get from that. And at the height of the pandemic here, we barely even came close to a fair value according to this indicator. Now, I know this indicator is fraught
Yeah,
with issues,
I
but
don't like this indicator.
no, well, I get it, but I think it's a good context of, are you getting a good value for your money when you buy, indexes right now, or just the U.S. economy as a whole, as far as market capitalization and stock market, value
I
or
think this was
price?
a good indicator before like a lot of foreign trade happened.
Okay, fair enough. That's certainly something to consider where you're getting a lot of foreign investment. Okay, I get that, but it still makes me go, okay, am I getting really excited about the valuations I'm getting here? Overall, suspect. Right, individual company can still be, very, much more valuable, but or underpriced, I should say. This is just highlighting that once again, that famous like Burry quote about how 2 orders of magnitude, the greatest bubble of all times. Um, I think this prediction is trending towards aligning with this prediction. In case, like,
Is the
I
author's
like
name in there?
Burry, but like
Oh,
you get to this point of like this. This is a Newsweek article from like 1996, I want to say, where someone was just like, stock market. Stock market, the internet. Like no one really cares about that. It's just a toy. In reality, it's completely reshaped our world. I think that prediction is as far off as this is at this point. Yeah, I get it. There's a lot of froth in the market, but to completely dismiss it and then, um, you know, you're just, I don't know if you'll ever see valuations like you saw in the 1950s, right? The market is too accessible now. Too many people participate in it. There's too much index fund investing going on through retirement accounts. It's just not the reality we live in, I think, anymore.
This did you read any of that? Because that's embarrassingly awful. Man,
Yeah,
you
yeah, I
have
did.
his name in the title there too. Oh boy,
Oh yeah.
sorry, Clifford.
So
That's a rough take.
I know this chart scares the crap out of me though. So, one of the things I kind of pay attention to is, my long-term financial planning is when you're modeling in how much you need to save for retirement and those sort of things. You have to put in a number for what your reasonable expected rate of return is. And there's a whole wide school of thoughts here. People will say like, oh, go super conservative. I only put in like 5% or whatever the risk-free rate is, which is like a treasury yield, which is like 4%. Some people say, well, since 1957, the stock market returned roughly 10% per year. That number can be a little deceiving though. In that you're picking exactly these two time points. If you shift it by just a couple of years, you now have a average rate of return that's like 7%, right? So when you do your projections, what number do you put in for like how much money you anticipate to have when you retire? I'm just kind of curious.
You mean into my retirement?
Yeah, no, like yeah, if you're projecting like I'm gonna have this many dollars when I retire, like what number do you put for like your rate of return?
I'm probably the worst person to ask for this because I
Yeah.
highly disagree with the concept of a 401k or a Roth. I yeah, I know that this is not what you were hoping for.
Yeah.
I think it is much better to have property. So
Okay.
I use current cash flow. I'm trying to buy more property. So I put
Okay.
in a small amount as a backup. It just doesn't make sense to me to not utilize cash now when I've already, bought a second house. The first house has created a lot of cash flow. I just,
Okay.
I would rather do that like 10 times than have a bunch of
So
money in a 401k.
what do you look for as far as like a rate of return on the property? As far as like what is your capitalization rate that you look for?
It's not just rate of return, it's cash flow per month because then I
Okay.
can so in property, and there's gonna be people that disagree with this. I understand. This is not what this is supposed to be about.
Yeah.
I get a certain cash flow per month, and then the house increases over time, which I can then
Mhm.
use to leverage like a home equity loan to get other property. So I'm I'm the worst person to ask for the 401k thing.
Well,
I think 10% would be great. I'd put in a little bit as a backup in
yeah.
case I fail in my life. So I don't.
Yeah, no, no, I completely get what you're saying. It's more the question is kind of like what rate of return do you kind of target when you're doing it? Real estate is same thing as it would be investing in like a 401k or an IRA. It's just like what are you hoping to achieve as far as like a number? Because there are rental properties out there that have a 2% rate of return as far as
Yeah,
the capitalization rate, and there are other rental properties when people do like Airbnbs where they're looking at like 30%. Um,
it's
it,
it's not
it can be pretty wild.
realistic for me to have a standard percentage because
Nope.
one year my house went up 100%, and then
Yeah.
the next year it went up 6. So it's like, yeah, I don't.
Yeah,
It's
fair enough. But when you're doing these projections, one of the things you have to take into account is what the valuation of like the underlying object is compared to its historical kind of average. And this is designed to create a trend here of the PE ratio to a 10-year rate of return. Okay. And when we look at where we are right now, this 26 territory, you're looking at expecting a 10-year rate of return of sub 5%. This is the scariest chart out here to me.
yeah, it's
Right?
not good.
Yeah, I've never assumed a sub 5% rate of return. I mean, hell, right now, like the, you can get 4% on a 10-year treasury. So that's basically saying you're going to get the risk-free rate is kind of your best hope, which is why bonds have been so attractive.
Right.
You've
Yeah,
seen their prices shoot up through the roof.
it's
Um,
pretty
but yeah,
disgusting.
yeah. So, other people will tell you should take like a glide slope approach where you have, 10%, 8%, 6%, depending on which decade of like your workforce you're in. But it's definitely a little concerning, and I'm curious what other people put into their financial calculators for their anticipated rate of return over the next, 20 years. Say.
Yeah, I mean, if you look at those like analysts from like Chase or like JPM, whatever, they always say like the next 10 years in the stock market, we will not gain that much. But, they also said the internet's going to suck. And when the iPhone came out, they said it was trash. So,
Yeah.
I don't, no one knows. It's kind of rough. But if you guys in the comments can tell us if you think this is going to take off or reverse, I'd like to have a poll of what the sentiment is. Because I feel like we're more pessimistic than others. Because other channels are just like rocket all the time. Every
Yeah.
year's a rocket. So, all
I love it.
right,
All right,
guys.
guys. Catch you next one.